This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on the failure mechanics of dealer banks. This chapter was written by a professor named Duffy, who teaches at Stanford University. Actually, he is a distinguished professor of management and finance. It's a relatively short chapter. It's extremely well written. And the good news for you guys is that there are only 3 learning objectives. And those action words sound pretty similar. Let's go ahead and read through those pretty quickly. Compare and contrast major lines of business, identify situations that can cause a liquidity crisis, and then assess policy measures. There's only one slide at the end of this relatively short slide deck on that third learning objective. So I think the focus is going to be on those first 2. But what I want to do before we get into the body of the slide deck is I want to read a direct quote from page 55 from this article, because it really kind of summarizes what I've learned as an academic when I was back in graduate school, and then trying to publish for 10 or 15 years, and then trying to take that research and apply it to the classroom, and in this case apply it to a journal article, so that you and I can become better familiar with this concept of dealer banks. So I'm going to read this quote to you. I will tend to simplify by treating large dealer banks as members of a distinct class, although in practice they vary in many respects. I focus here on their most significant lines of business. These include intermediation of the markets for securities, securities lending, repurchase agreements, and derivatives, prime brokerage for hedge funds, and asset management for institutional and wealthy individual investors. Dealer banks also conduct proprietary trading, that is, speculation on their own accounts. Now, I read that to you over the last minute for a couple of reasons, but primarily to emphasize what I try to do and what professors everywhere try to do. I will tend to simplify. And so that is really a good signal that this article is it's reasonable and it's approachable by many people, especially those of you who really take this stuff seriously. I also want to comment on Professor Duffy's tremendous research record. When I was in graduate school, I would consume these academic journal articles because they were very difficult, and it was our job to try to simplify them. And some professors did a really good job of helping us, and some did not. But this guy's published in the Journal of Finance multiple times, and this is how I learned finance. So whatever I'm being able to pass along to you guys comes from my long history of reading academic journal articles from Journal of Finance, which this guy has done. So keeping that in mind, that these professors, they are accessible. They don't operate, at least most of them don't operate on such a level that you and I can't understand. All right, so let's go ahead and get to the introduction. And what I encourage you to do is go back and look at the actual article and read his story. And this is really cool. There's a story about Alpha Bank, and it's a dealer bank, and it has all these different kind of problems and all these different kinds of solutions. And it's really an easy read. So I encourage you to go back and read that first part of his article. All right, let's start with just a simple definition of dealer banks, large financial institutions. And so look at the illustration that we've put at the bottom of the slide deck. You've heard of all of these people, and I'm guessing some of you even work for these financial institutions. So conventional commercial bank operations, which means that they accept deposits and make loans, and also investment banking operations, which includes all sorts of activities, including underwriting both debt and equity issues. Now, how about that first learning objective, major lines of business? All right, so let's talk about some simple things. We probably know this: securities dealing, underwriting, and trading. All right, so we have 2 markets out there, right? Primary market. Always remember, primary market is the market when the financial security is created. So notice what we have there: dealer banks buy equities or bonds from the issuer and then sell them to investors. This is the primary market, so that debt or that equity security is created. And remember now, so these businesses, right, these corporations, let's suppose that I'm Jim's brush company and I make brushes to help people clean their bathrooms, right, the commodes and the showers and the sinks. I make these brushes and I have this fantastic idea for a new brush. I need $100 million. So I pick up the phone and I call a dealer bank and I say, hey, I need $100 million. You figure out, should I issue debt or should I issue equity? So, there's a lot of advising going on back and forth. And so I want my money today. So you guys, this dealer bank will send me my $100 million today, and then I give the dealer bank the right to sell those debt or equity securities, right? And so what are you dealer banks trying to do? Buy low and sell high, of course. So sell them to investors. And then after those securities are distributed to investors, well, some of those investors, they probably want to hold on to the bonds until they mature. Some of those investors want to hold on to their equity securities for the rest of their life, but lots of them are going to want to trade. And that's why we have the secondary market. So the dealer, buys at the bid and then sells at the ask. And so there's the buy low and sell high in both primary and secondary market. Now, of course, dealers can engage in speculative trading in both of those markets, which means that there's the possibility of buying high and selling low, or buying high and never ever being able to sell. Essentially, those securities can become worthless. And then as part of this, the dealers serve as intermediaries in the repurchase market. So let's go ahead and look at an illustration of a repurchase transaction. So we have the blue and we have the light red over on the right side. And this is how I teach my students to remember their repurchase market. And indulge me here for just a minute. Let's just suppose that I'm Jim and I need some money. I need to borrow some money. So I come to you, and maybe you're just an individual, but maybe you're a financial institution. And I say, I need $100. And you scratch your head and you say, okay, I don't know anything about Jim. What's his income? What kind of a job he has? Is his wife and children, are they demanding a swimming pool to be built in the backyard? What is Jim's attitudes toward risk? So you go through all of that credit analysis, and you may or may not say yes to me for that loan, depending on how I answer all those questions. But then I say something to you, and I'm going to go ahead and pick up my calculator. Those of you who watch my videos know I use this calculator. How about if I say to you, look, I'll use this calculator as collateral. So now you're thinking, okay, there's a little bit less risk involved. But then you look at this calculator and you say, you know what, Jim, that calculator is probably older than you are. And if I sell it, maybe I'll get $1 for it. And I say, wait a minute, this calculator was valuable. It helped me pass a whole bunch of tests during my lifetime. Well, that doesn't have any meaning to the financial institution. So then I say, wait a minute, I have a treasury in my back pocket. Will you take a treasury bill? So now the dealer says, okay, this is something that I can handle. So we go back and forth, and maybe during the conversation, I say, well, I only want this to be a one-day loan. And you say, that's great, because I only want this to be a one-day loan. So then we get more sophisticated, and I say to you, all right, I have this treasury. I'll sell it to you today for $98. And I'll agree to buy it back from you tomorrow for $99. There's the repurchase market. So what am I doing? I have $98 today, so I'm borrowing money from you, and now I have to do something with that $98. I have to make $1 by tomorrow. So I can take that and I can go to Las Vegas and I can bet it on the red or the black or some number, or I can go to the racetrack and bet it on a horse, or I can buy shares of Amazon stock, or I can do a whole bunch of other things, but it's a contract. So I need to buy that treasury tomorrow for $99. So there's the repo. So there's the repo on the left-hand side, and it's the reverse repo on the right-hand side. So this is just a simple illustration here, right? So what do? I hand my treasury over to you guys. You're the dealer bank there in the middle. And you lend me, what did I say, 100 originally, but let's make life more interesting here. Of course, we're not going to do this for $100. We'll do this for $10 million. And then the dealer is the dealer in the middle. And so, of course, there's going to be somebody on the other side with this reverse repo. And so the dealer then collects that 10 million from the person over there, from that institution over there on the right-hand side. And so then tomorrow, we just kind of reverse it. So notice the securities go one way today, and then they go the other way tomorrow. But then here's where it gets interesting. So it's 10 million and then $2,778 that gets transferred. So what do I hope? I hope, of course, that I took that 10 million and I turned it into, let's just say some crazy answer. I turned it into 20 million by tomorrow, and all I have to do is pay you a measly old $2,778. Now, of course, forget about how much risk I took to double my money, but that's essentially what's happening. And of course, if I only turn it into 10 million and $1, I still have to come up with the rest of that $2,777 to pay you. Now, of course, what you're going to do as the dealer bank is that, you want to act as the intermediary. So it would be great if you could just transfer that money instantaneously, and you're going to charge a fee. Of course, you're going to charge some kind of fee. Maybe you'll charge me, 10,000, and maybe you'll charge the other person 10,000, or maybe it'll be 50,000. Depends on a lot of different things. Of course, what it depends on is if I have to use this calculator or if I use a treasury bill. But there might be some type of a haircut involved in there, depending on what happens between today and tomorrow, and all sorts of other factors. So thank you for indulging me in that short story. But I think that illustrates exactly the risks that the dealer banks are faced in this repo market. How about some risk factors inside of this particular line of business? So risk of undersubscription. So what did I allowed you to do? What did I say? $100 million worth of Jim's Brush Company bonds. So what might happen? Maybe you can only sell 90 million of them or 30 million of them. Look at the first circle point there. Dealer banks may be forced to hold the securities themselves. All right, so that's one risk. How about in this repurchase market, right? So by guaranteeing a repo trade here, let me go back here. So if we look at this illustration, remember that in an ideal world, the blue and the light red people, they would be able to get together and argue about the terms of the contract and then agree on the terms of the contract. But both of these people are willing to pay a fee to you, the dealer bank, so that there can be things like lots of liquidity and marketability and speed, et cetera, et cetera. And so look at this risk here. You're guaranteeing the trade on both sides. So you're exposing, the dealer bank is exposed to default risk. And remember, here, let me just go back 1 second. Now remember, let me just use an option term here, over the course of one day. And remember, repos, they don't have to be one day. They can be a week, they could be a year, they could be 50 years if you really wanted to. That doesn't make a whole lot of sense. So let me use an option term here. One side is going to be in the money, one side is probably going to be out of the money, although, it depends on the actual terms of the contract. So as the dealer, it's not like both of these people here, let me just do an illustration. It's not like both of these people are smacking the dealer bank in the head at the same time, because one will be in and one will be out of the money. So you're getting blasted from one side, you're getting blasted from the other side, depending on market value. So what does that risk say? Exposes itself to default risk. All right. How about collateral? So look, if you are going to sell this thing, you're probably out of luck. But a treasury bill is a completely different story. And then there's this systemic risk, which means that, remember, we're a dealer bank and we're not operating on an island. It's not just us. There are tons of other dealer banks out there. And so if we have dealer banks out there who are experiencing periods of financial distress or nearing the point of bankruptcy, then there can be an impact across the entire market. How about the second one, over-the-counter derivatives? So remember that the way I learned this back in graduate school, and the way I teach this to my students, is to start on the organized exchanges and talk about the value of the members of the exchange and the clearinghouses inside of the exchange and how they guarantee all the transactions. We've talked about that before. And then I moved to the over-the-counter market, which, I always tell my students that the organized exchange, it's called an organized exchange because organization means something on that exchange. The over-the-counter market, I tend to use the word like chaos. I mean, it's not really chaos, but, there are a different set of rules and different set of players and different sets of environments. And so in this case, almost always, one of the counterparties is going to be one of these dealer banks, right? Notice that first circle point. Most prominent contract is the interest rate swap. Plain vanilla interest rate swap, fixed for floating payments. And so the counterparty is probably going to be one of these dealer banks. Now, of course, we're going to run these matched books as a dealer bank so we can transfer risks and try to make sure we get offsetting positions. And in a perfect world, whenever anyone comes to us as a dealer bank, we would know somebody else out there who wants to take that opposite position, and we would just, stand there in the middle and smile and, charge a fee or, perhaps a haircut on both of these parties and let the mayhem begin out there in that particular market. But of course, life is not perfect. We don't always have these perfect abilities to offset. Which then means, look at that last block point there, which means then that if we have a position as a dealer bank, then the easy solution is to go and find some derivative that's going to help us. And so credit default swaps help us there. All right, risk factors. Of course, systemic risk, we just talked about this. Counterparty risk, we talked about that. And market risk, of course. How about some interesting statistics? Look at this risk exposure. Go back to 2009. What is that? 3.7 trillion, and in 2019, it's 2.6 trillion. So, this is a massive reduction in exposure. And so you got to ask yourself the question, why has this occurred? And so as I was reading the article, my first thought was, well, we had this event in 2008 and 2009 where we had this crisis. And then we have lots of good organizations and lots of good governments out there and lots of good authoritative bodies who are saying, okay, let's take a step back. Let's rein ourselves in. Let's try to follow all these new rules, right? We've talked about the Basel multiple times. So my first thought was, okay, this is probably dealer banks and the entire financial institution industry just getting smarter, learning from experience. And I think that's probably a part of it. But what the article emphasizes is some seasonal factors, which I think are important in themselves. But these compression trades, I think, are really important, where redundant or nearly redundant positions among dealers are canceled. So I think I was right in my first thought that it's because of that 2008 financial crisis. So dealer banks were looking to say, okay, how can we be more efficient? And the execution of these compression trades has increased the efficiency inside of these banks and, of course, throughout the industry. How about the third part, off-balance sheet financing? Whenever I think of off-balance sheet financing, my brain automatically goes back to 1999 and 2000 during the whole Enron spectacle. So this is important here. Dealer banks, of course, dealer banks act as a sponsor in almost all of these off-balance sheet products. And so the dealer bank is responsible for setting up this special purpose vehicle or the special purpose entity, and then sells those loans off to other entities, whoever they are, hedge funds or endowment funds or whoever it is that wants to buy those particular securities. Now, remember, this special purpose vehicle then issues debt to third-party investors, and then the dealer bank uses the proceeds to help out the sponsoring bank. And so there could be all sorts of crazy terms inside of the special purpose vehicle, and the dealer bank has to be responsible for those, in addition to using the cash flows from the underlying pool of assets to make payments. And so sometimes the dealer bank does that itself, and sometimes it offloads those to another third party. So there's the last block point. Some dealer banks may also act as third-party investors and do all sorts of things as third parties. Risk factors, massive losses, and then maybe forced to bail out those special purpose vehicles. Here's a good stat. Go back to June of 2008. Citigroup, $800 billion in off-balance sheet assets. And how about the fourth major line of business here, prime brokerage and wealth management or asset management? All right, so as prime brokers, dealers provide hedge funds and other large financial institutions, like mutual funds and pension funds and endowment funds and anybody else that wants, cash management services or working capital management services or some kind of securities holdings or tax planning and tax accounting. And of course, not only does this apply to wealth management or asset management division, but it also applies to derivatives and how this asset management may or may not be a derivative counterparty. All right, what are some risk factors there? Insolvency risks, so a large number of clients, liquidity risk, and insufficient funds. And how about the learning objective that says something like this? What happens that is going to cause us to put our hands on top of our heads and say, how could that possibly have happened? Right? So what situations that can cause a liquidity crisis at a dealer bank. Now I'm going to go ahead and reverse back to some of our discussions from previous chapters and previous learning objectives. Remember, we always have this model where we're the umbrella, we've got the chief risk officer, and this really smart individual, this really smart man or woman is going to decide, what is our appetite for risk, what is our risk culture. But in almost all of our conversations, we use the word anticipate. So let's figure out what can possibly go wrong, and let's go ahead and be prepared for it. It's all part of that identify risk, quantify risk, and manage risk that I've told you guys before. Let me take a quick sidelight here. Those of you who are sports fans, I wonder if you watch those 30 for 30 shows on ESPN. But there's one on Bill Belichick and how Bill Belichick, who's the coach of the New England Patriots, for those of you who don't know, he's notorious for preparing for the worst possible scenarios during a football game. And his players are interviewed and they always say, Bill is worried about this thing and this thing and this thing. And they say, Coach, when does this happen? It happens once every 100 years. But the players then realize that, oh my gosh, this coach is really smart. This is why he's won 100 Super Bowls, because he's prepared for every eventuality. So that's what we're doing here, situations that can cause a liquidity crisis. All right, how about number one, flight of short-term creditors? All right, of course, dealers finance their medium to long-term assets, but let's go ahead and emphasize long-term assets by using short-term funding sources. And the obvious notion here is to say, okay, we have all of these deposits, right, if we operate as a commercial bank. But deposits, they go up and they go down. Let's use the repo market, because we have these assets on the left-hand side of our balance sheet. We invest in treasury securities. Why don't we use those as collateral to be able to help us manage our liquidity position? And so what happens if the dealer's creditors fail to renew their positions in full, then we might be unable to finance our assets. So how do we mitigate these kinds of issues? Alternative lines of credit, buffer stock. Boy, we talked about buffer stock in multiple previous chapters. And then laddering the maturities of liabilities so that we don't have this big old lump sum of a matzo ball that plops into our lap overnight. We ladder these maturities. And what does laddering do? Of course, it means that we're only going to have these cash outflows at fixed intervals in the future. But the more important thing is that it allows us to plan for those. How about a departure of prime brokerage clients? What this simply means is that, we have clients who may find a better opportunity somewhere else, and it might not be that there's a better opportunity somewhere else. It might be because they're just not satisfied with their perception of our management of liquidity. All right, so let's go through these block points pretty quickly here. All right, so the dealers often use cash and securities of their clients to meet their own liquidity needs. Let me pick up my calculator again. Remember, if I use this financial calculator as collateral for some contract, then you can rehypothecate this and use it to collateral for somebody else. And so, of course, you'd be silly to A, accept this as collateral in the first place, and then B, try to use it in the rehypothecation market. All right, notice the second one. This is what I was talking about initially here. If a client detects insolvency or general liquidity turmoil, wow, well, this is going to be a signal that, you know what, let's go somewhere else. All right, so what's the trigger? Series of events that can cripple or handicap the dealer liquidity's position. Inability to rehypothecate, other lenders refuse to do business, and then clients move their assets elsewhere. And there's a case in point there, Morgan Stanley back in 2008. And of course, when you say between August and November of 2008, comma, it doesn't really matter what you write after that. You know, you're going to say something went wrong. You guys remember the story that I told about me being trading in derivatives and you guys being on the opposite side of that forward contract? And if the spot prices moved against me and you come knocking on my door, I use the imagery of, I'm not going to answer my door. I'm going to go run around the block and you're not going to be able to catch me. So let's call this ducking for cover. Counterparties detect an increase in insolvency risk. All right, so here we are. You and I have this contract, and we're approaching the maturity date of the contract, and you know that your position is in the money, right? And so you're going to come, and I'm going to have to reach into my pocket and pay you a bunch of money. Well, I may have lots of money, but I also might be under pressure from a short-term position. And if you know about that, then you may do a couple of these things. I mean, there are all sorts of things that you can do and that I can do that these counterparties can do. Borrowing, entering new trades, harvesting cash, and novation. I mean, this is an interesting thing. You know, novation, and there's a case in point down below, Bear Stearns. You know, we have this contract and you or I don't like the terms of the contract, or you or I want to get out of the terms of the contract. I mean, whatever the reason is. So then we go over here to another bank. Maybe it's the Alpha Bank from the beginning of this academic journal article. And the Alpha Bank comes in and says, you know what, I'm Superman. I'll come in and I'll save the day and I'll take over one of those positions. And of course, the Alpha Bank could take over one of these positions, and they're not going to do it and say, here, I'll take over this position, and here's another $1 million on top of it. Look at the last sentence in the case in point. This further worsened Bear Stearns' already dire cash position. Okay. How about loss of cash settlement privileges? All right. So what do we know? We're as a dealer bank, we're a part of this whole financial institution. But, you know, we have to deal with people like the Fed, we have to deal with people like clearing banks, and we have to deal with people like, you know, clearinghouse corporations. And so, boy, if these trades are occurring and someone is worried about our liquidity and our ability to conduct business in the relatively short term, they may cut off those positions, those privileges as well. Look at that case in point. Lehman's Clearing Bank, okay, that's JP Morgan, invoked its right of offset and refused to process Lehman's instructions to wire cash needed to settle Lehman's trades with its counterparties. All right, so you have this wire transfer, and you say, okay, I'm going to have the money here, here's the money there. And if it doesn't work, well, then that's a huge problem. Now, how about that last learning objective about policies? And so before you even read this slide or go back to that, to the academic journal article, this is probably what you would come up with. So policies by governments, policies by central banks, policies by authoritative bodies and organizations that are designed to, try to improve the quality inside of the industry. So outside of the industry doesn't have to worry about the industry. So let's just go through these quickly here, right? Increased capital requirements, which include off-balance sheet positions. Fed acting as a lender of last resort. A central clearing can mitigate flight risk by reducing total exposure. So 1, 2, and 3, we've probably done all of those things. But we could establish an emergency bank to orderly unwind the repo positions, which, notice that emergency bank is in quotation marks. And sometimes this happens, just go back to 2008 financial crisis where the government stepped in and said to certain financial institutions, hey, will you do something for us, et cetera, et cetera. And that takes us through those learning objectives. So I think the third one, policy measures, that's consistent with learning objectives that we've had in other chapters. But I think questions from this chapter will most likely come from those first two.